Hello, everybody. It's Michael Moskal, Director of Investments at MGO, and I am here today with Brad Wingler and Justin Petrus, and we are going to talk a little bit today about our views, current views on the investment markets and the economy. And there are four main topics we want to talk with you today about. And one of them, of course, is tariffs that you see the picture on the left side of the screen. Tariffs on the news every day. It's a critically important thing that is going on and having a big impact potentially on the economy and also the investment markets. The second thing is the middle of the screen. You see the different flags of foreign countries there. Those are, we talk about non-US stocks. Really, for a number of months now, we've been increasing our positions in non-US stocks going back. Boy, it's got to go back to probably the fall of last year, guys. And what are we up to, Justin, now for non-US stock position?
Uh,
About 30,
31%.
31%.
Yep.
So in our equity portfolios, which many clients are in, of course, that we're up to about 31% in non-US stocks. Why, you may ask? Non-US stocks have done very, very well. They're actually positive, and we're going to see in a minute, they're positive up about 7% for the year through April 30th versus our markets being down about 5. So it's been a very good thing for clients having non-US stocks. In the upper right, we see people taking away pieces of the globe. This has been a theme of ours probably for at least a year, if not longer, called deglobalization, where countries start sort of closing up a little bit, and that's tariffs are part of that. Countries start not working together as much, and that, of course, has a significant impact also on the economy and markets, which we'll touch base on. And then the bottom right is what's going on. The gentleman you recognize as President Trump on there. The other guy is Jay Powell, who is the chairman of the Federal Reserve. And the Federal Reserve is the entity that controls short-term interest rates. So they actually can make rates go up and down. And there's a lot of pressure right now on the Fed to be cutting rates. And not just from the president, but also from Congress. Politicians generally like rates lower because lower rates mean that you, me, and consumers, and generally speaking, are going to borrow more money to buy houses and buy cars and spend money. And when we're spending money, it gets the economy going. So politicians like the economy going. So there's a lot of pressure right now. We'll see if the Fed gives into that pressure and cuts rates. All right, next, a little technical difficulty. All right, 86th year that we're in business, and obviously like to be around 86 more years. We're actually a fifth generation private company now, and again, looking forward to a lot more years. Warren Buffett was in the news this past weekend. His company, Berkshire Hathaway, had their shareholder event this past weekend, and Warren Buffett kind of shocked everybody by announcing on the very last day that he was going to be stepping down as the CEO of Berkshire Hathaway, which he's been the CEO for how long, guys?
Jeez.
60
60,
years,
was it 60
A
years?
long
something
time.
around there.
Something like 60 years, I think. Yeah, 60 years. So, we've been a huge fans of Warren Buffett over the years. Of course, Warren Buffett's a multi-billionaire. He built, from scratch his company, and we try to follow a lot of his principles and what he does and how he manages money. And that's worked out very well for our clients. So we thought we just would put three of our favorite quotes over the years on this slide. The first one is someone's sitting in the shade today because someone planted a tree a long time ago. And that was his way of sort of communicating that you have to have patience in investing. And Brad, you like this quote. I know you had a comment or two on this.
Yeah, I like both these last two. Price is what you pay, value is what you get. And I always think of that. He spoke one time about his thoughts of buying a company, and people worry too much about the price of it. And what you should think about is, do you want to own this company regardless of whether or not you know what the actual current price of it is in the stock market? In other words, if you don't want to buy a company and hold it for 10, 20, 30, a really long period of time, or at least going into it thinking that, then you probably ought not own it at all. And it's just a great way to think about investing. He's very much a person who believed in long-term investing. And I'll grab that last one too. because this one reminds me of several times during my career. Um, Only when the tide goes out do you discover who's been swimming naked, which is obviously kind of funny, but
It is. It
yeah, the
is.
reality is, you think about times in the markets. I mean, the financial crisis, the dot-com boom, right? People were buying
Mhm.
all these dot-com stocks. A lot of people didn't even know what these companies did. The financial crisis, to some extent, AI. AI is different, I think, on a lot of levels, because a lot of these companies actually have real earnings. And even, private equity, private credit, more recent. So sometimes people jump on things that are hot, but they don't really know the true value of them. So it's easy to make money when these things are going up. You just have to know when to sell those things and when to move on. But it's
Yeah, Warren Buffett, of course, is called a value investor.
yeah,
So he's looking for great companies at reasonable prices because he buys individual stocks. So Brad, you're right. For us, with the little blurb down here, if it looks too good to be true, it probably is. That's regarding during the dot-com bubble, like you said, even subprime, when that was going on with mortgages back in the mid 2000s, that first, the first decade there. When things look too good to be true and you can make so much money by just throwing money at stuff, that's what he was tries to say here, right? Is that it doesn't work that way. You got to do your homework. You got to buy good companies at reasonable prices. You can't just throw money at things and it just goes up and up and up forever.
yeah,
So
agreed.
again, we operate our investing philosophy on a lot of what Warren Buffett does. Market scorecard. How do we look through April 30th? That's the first column that we see here. It's 2025 returns through April 30th. Through April 30th, actually, our MGO equity ETF portfolio, which is our largest equity portfolio by far, most of our clients are invested some way, shape, or form in that portfolio. Just about even for the year through April 30th, and that was, versus the S&P 500 being down 5%. The reasons for that are, Justin, you had mentioned about, international,
Mhm.
foreign. So again, looking at the DJ Global XUS, up 7%. So with 31% of our money in non-US stocks, it's helped us out a lot. And Brad, you'll say a couple comments on gold in a minute, but we also have a nice slug of gold in our portfolios, which has helped a lot. And so I think actually, Justin, is it year to date? I think we're actually positive, aren't we, with our equity ETF now through
We
May?
are. Equity ETF, let me take a look here. We're up in the 1.5% range for the year.
Yeah, 1.5, and I think the S&P is still down 3 or something. So
S&P is down 3.5.
yep, so we're significantly outperforming, which is really nice this year. I have the equity income portfolio on here because that's the value stocks, a lot of dividend stocks in there. That's been positive for a long time for us. And bonds are up 3%. That Bloomberg U.S. government credit. So bonds have been a nice ballast this year against risk, like they're supposed to be. And then Brad, you want to say a couple of things on gold? I know you're a big gold guy, so
Yeah, just been watching gold a lot. Obviously, gold is still the only positive asset class for each of the last 4 years. Gold's been on a tear. And you think back to when does gold do well? Gold does best when there's periods of uncertainty. And there's uncertainty right now. And so gold was actually up $100 an ounce today. I was shocked at how much it's been up. It's been on an absolute tear. So sometimes you have to wonder, do you get that? Maybe you get that reversion to the mean, but right now we're happy that we have a bit of an overweight in our equity ETF portfolio. So it's been
yeah,
doing quite well.
for sure. And we've had a lot of clients that ask us, why is gold going up? And there's lots and lots of reasons. Another reason, by the way, is uncertainty. Certainly, people will go to something safer. Also my son Ryan, who's a junior, well, he just finished his junior at Ohio State. He's a finance major, but he was telling me one of his professors said, well, China's been selling, U.S. Treasury bonds and buying gold. And if you actually look at the chart, we don't have it in here, but if you look at the chart, it goes, it's starting in 2017, they've been doing this. So you have a lot of foreign countries also that are buying gold to try and diversify, outside of something like U.S. Treasuries. That's another driver of gold returns.
That's a finite asset class. So it's a finite asset. So
Yeah.
people buy it, price is going to go up.
Oil prices are down, which for consumers, for us going to the pump is good news. We probably are going to see, what are you guys seeing at the gas pump right now with gas prices per gallon?
Under $3, well under $3 a gallon.
Yeah.
Yeah,
So
I want to
maybe,
say around 3 over here in that general range.
so wouldn't be shocking because oil's gone down quite a bit, in the last week and a half. So it wouldn't be shocking to see $2.50,
Mhm.
which is kind of good for all of us. It's not good for necessarily for Chevron, but for consumers, it's good. And then Bitcoin, Bitcoin's again an asset class sort of by itself. At one time, they were talking about Bitcoin being like gold, but if you just scroll through look at the returns on here, it doesn't follow what gold's doing. So it's not quite that. We look at it as more of a speculative asset class. It is something worthy potentially to have some money in. If you're looking for something a little more juicier to try and juice returns up a bit. It's about flat for the year. Interesting that Bitcoin has a 93% correlation. That means it moves correlated to the NASDAQ. I think it's the NASDAQ 100, which is made up primarily of, Brad, of those big mega, the Mag 7 companies, the Google, Microsoft, Nvidia, those companies. So it's been moving whatever kind of the way they're moving their prices with stocks is how the Bitcoin's been moving.
Mhm.
All right, tariffs obviously in the news every day. It's very important to what's going to be going on now, as well as just going on in the future here in this country. So, there are some positives with tariffs. If you look at tariffs is just a tax, right? It's a tax on imported goods. So it raises revenue because it's a tax. And I think part of the motivation of doing tariffs is to try and offset potentially down the road some domestic tax cuts that the administration wants to do. So, but raising revenue is one of the positives. Protection of U.S. industries. Obviously, there was a situation a number of years ago where China was dumping steel in this country because they were over flooded with steel production in their country. So they started dumping steel at really cheap prices here. And I think that was back in maybe the mid 2000 mid to the last decade. So it would have been 2015, 16 in that range. And so
Mhm.
we tariffed them. We put a tariff on steel because we said that's not fair. So it's not like tariffs are anything new, by the way. Like in this country, the first tariff was 1789. That's been a long time ago. So we've had tariffs throughout the years, some a lot, some down, some, sometimes not a lot, sometimes a lot. So uh, negatives, obviously, it's going to increase prices. So, already there's a number of companies that have come out. Mattel, who makes toys, has already come out and said they're going to take probably $270 million, cost hit on their imported goods from China, and they make toys. They got to sell toys. So they said consumers are going to be paying a lot more for toys coming up. So retaliation from countries, we've seen this from countries. Which countries, guys, are, retaliated already?
China,
China,
Canada.
Canada.
Yeah, China and Canada came out and said, "Fine, you're going to tariff us. We're going to tariff you. Tariff you right back." So, that creates conflict. Again, that's all part of this whole deglobalization theme that we have. In the conflict. Supply chain disruption. It's not so easy. Sometimes it's communicated. Let's just start making stuff here in this country. It's like, well, if you don't have the, production capabilities here yet, it's going to take years and years for that to happen. So, and that disrupts supply chains.
So some of that is starting to happen though, especially if you look at like semiconductors.
Hmm.
Think about Intel, the factory that they're building down in the huge factory down in Columbus,
Oh, they have the
and they're not
chips.
the
Yeah.
only ones. There's been
Yeah.
a number of other announcements of semiconductor companies building fabs in the United States.
Yeah. And I think that was part of the $50 billion CHIPS Act.
Right.
Now, it's not going to happen overnight.
Right.
It likely is, when they were talking about Intel, oh gosh, it's like, in our view, I think it may take a decade for them really
Mhm.
to do all this stuff. It's not so easy to do all that. And so it's moving in the right direction, but sometimes the media portrays it as it's going to happen overnight. It's like, no, it's going to take a long time for this to happen. And that's not a bad thing, right? As far as making chips in this country, because that's another industry that you want to have protected here.
Right.
Besides we mentioned, COVID, the vaccines, antibiotics, but chips are a super important part. And if it's all being made overseas somewhere, that puts you at a disadvantage with other countries. So again, this is all sort of weaves into the whole tariff and deglobalization thing. There's positives and negatives about it. What are we doing in response to some of this, with tariffs? We've been diversifying portfolios besides buying more non-US stocks. Here in this, here in domestically in the US, we've been buying more of consumer staples, some of the energy companies that, are more domestically based, so they're selling their products primarily to people who live here, so they don't really get impacted too much by tariffs. And they're also price elastic we have on here. So people, need to go fill their car up with gas, or plug in an EV. That's energy too. So energy is not just oil. Energy can be things like data centers, it can be EVs, it can be electricity, it can be all kind of different things that are energy. So, and of course, all these pictures on the right side of the page here, people are still going to have to brush their teeth. So they're still going to buy Crest, or other toothpaste. They still need batteries. They still need dog food, and they still need Tide, and they still need Pampers, and all these products people still need, regardless of what's happening, with tariffs, or regardless of what's happening in the economy. The other thing that's happening with tariffs is, and we've seen announcements, right, by Ford and some of these companies that are going to take hits on their corporate earnings because of tariffs. And that's true. It's negative for U.S. corporate earnings for sure. And some have estimated it's gonna take down earnings by potentially something like 10%, not 10 percentage points in earnings, but 10% from where the estimates were. So that hurts companies. How do you protect against doing that? Again, you buy more stronger domestic type sectors and companies. Defense industry, Lockheed Martin, food, Kroger, Wells Fargo banks, those are all domestic based kind of companies that sell their products to primarily just domestic based people, us, people that live here in America. We talked about deglobalization, again, that's a big theme for us, not just for now. Again, we think it started a number of years ago and it's going to continue. This whole cycle is going to continue for some time. And we just mentioned the sectors that benefit from this. Healthcare is another one, by the way. When you look at healthcare, not drugs, by the way, drugs are sold, internationally. But when you look at hospitals like HCA Healthcare, hospitals here don't have foreign, usually a lot of foreign customers. They're going to be mostly people who live here. So that's another industry that's protected quite a bit. Fed cutting rates. What do you think, Justin? Look at rates. What would be your rates are at what? Where are we at right now with the Fed funds rate? We're at 4.5, I think.
I believe it's 4.5, yeah. And there seems to be a pretty wide array of opinions on what's going to happen with rates. So, for example, futures markets kind of signaling that they think that we're going to get a rate cut here in July and then have 3 additional cuts by the end of the year. Barclays right now, they pushed its estimate out from June back to July for the first cut. And then they expect 1 more cut in September. And then Morgan Stanley thinks that there's not going to be any cuts at all until 2026 unless we have a recession, which some people think may happen. But it is interesting. There's a pretty wide array of opinions out there.
Yeah, and I think our consensus with us as advisor, our 6 advisors group here, I think we do expect the Fed's going to cut rates.
Mhm.
Yeah.
I think we expect it to happen because the economy is weakening. Tariffs are going to weaken the economy to some degree, but there's a lot of political pressure being put
Broad
on Jay
pressure, yeah.
Powell. And this being his last year as Fed chairman, he certainly does not want to go down in history books as being around and something bad happens. So he's probably going to do his best to try and make sure things look okay, which means cutting rates probably.
His face in that cartoon tells the story there.
Yeah, I know. It's sometimes you feel bad for him because there's a lot of pressure on him.
How
But
how soon do you guys feel like the rate cuts will come?
I'm gonna, and then you guys can weigh in on this. So I'm gonna say, Brad, it could be as early as June. I'm gonna say it's gonna be June or July. I think tomorrow they're gonna be setting it up. I think because tomorrow they're meeting today and tomorrow the Fed,
Right.
they're not gonna probably cut rates tomorrow, but I think they'll be queuing it up. The language is going to be something like we're going to be ready. If some things turn down, we'll be ready to cut. They're going to start laying the groundwork for it.
Yeah, I think tomorrow they're going to hold tight, and then I think July we'll get a
I
cut.
think you guys are right. I think it's not at this point. If he does it right now, it sort of looks like he's giving in,
Right.
and maybe he doesn't want to do that. Maybe he probably wants to show some independence, but it seems like it's got to come pretty soon, maybe later this summer. But at some point, he's probably going to have to start cutting rates.
Hmm.
So we'll see.
Yeah. Yeah, and I think consensus wise, we think maybe about 100 basis points or one full percentage point off from where
Mm,
they are now.
yeah, around there.
So going from 4.5, essentially, it's 4.25 to 4.5, but 4.5 down to maybe 3.5, something like that. All right, and the last thing we're going to take a look at is our longer term outlook. Again, these are things that some of it's happening now, some may happen down the road. Non-US stock rotation that's happening already now. If you go back and look at the last 15 years, 12 times out of 15, you had US stocks outperforming, which is a pretty high percentage, and it's not necessarily always that way. So there's been times where it's just the opposite. So, we're looking at it the next, call it 5 to 10 years and saying we think that you may see the opposite happening, something like non-US outperforming US over that time period. And then value stock rotation. Value stocks, again, are more like the dividend stocks, or essentially you can say it's the non-technology stocks pretty much.
Nowadays.
So value stocks would be stocks that, again, we mentioned some of these, but companies like, Procter and Gamble, consumer staples, Kraft Foods, companies that make products that are more steady and stable. They're not innovating necessarily products, which means their stock price doesn't go up a lot, but it's not going to go down a lot either.
Right.
Higher debt and deficits. That's something that we're obviously looking at. That's the chart down at the bottom left. Over time, that's going to have an impact on interest rates as well as inflation, as well as the value of the dollar. That all impacts that. And, countries that rack up a lot of debt can get themselves into trouble just like households can. A household that borrows too much money is going to find themselves in a hole down the road somewhere. So we got to be very careful as a country about trying to get that chart not looking like that.
Mhm.
And then that last chart again goes to the value stock. Our theory or proposition on value stocks, where value stocks are going. On the right side of the page, the growth versus value, that ratio got to its highest level since July of 2000. That's 25 years ago. So could we have a period again on the bottom part of that chart shows what value stocks did versus growth from 2000 to 2007? Could we have another time period like that? What do you think?
It definitely happened.
Sure.
Yeah.
I mean, there's always, there's a concept called reversion to the mean, right? You could have growth outperforms value for a long time. I mean, you see it in the 401k world. Like you can often tell when a participant enrolled in their 401k if they pick their investments themselves because they own all the growth funds that are available in the plan, right?
Hmm.
And
Hmm.
it's and then it reverses and the performance starts to show the big difference. But that's one of the reasons why we preach the concept of diversification and asset allocation and making sure that you're not overweighting one versus the other. So, but markets do this all the time,
Hmm.
and they do tend to revert to the mean over long periods of time.
Yeah, and diversification is great. You bring that up, Brad, because our portfolios, our equity ETF and our other equity portfolios that we have, we do that on purpose to make sure they're diversified. Now we may be overweighting certain things like we do to try and get better performance, versus the markets. But we make sure that we're not putting all our eggs in one basket, as the saying goes, because that can get your basket crushed pretty pretty quickly. All right, any last comments that you have? If not, thank you for watching or listening, and we'll keep working hard and making money for you. And we will see you next time.
Thanks, everybody.